Saurabh Mukherjea joins us, represents Ambit Capital. Saurabh, good morning. Thank you for joining us. Saurabh, anyone who spent 5-10 years in the market knows that the importance of state election in the short term and in the medium term is not very relevant. But every time we have an important large state which is due for election, the market narrative, the market grapevine, dealing room conversations, I'm sure today in your morning meeting, 60% or 70% of the time must be spent around discussing the outcome of exit polls. Why is that?
Look, clearly I think whether it's IPOs, exit polls, budget day, we are all creatures of the moment, right? We all live for the moment, we die in the moment. So in a job like stock market investing, broking, you're necessarily focused on the short term, and you're right. Today, all eyes are on the exit polls, and over the weekend, I'm sure the results will be keenly looked forward to. But as you're saying, I don't think this is this is the be all and end all. There are 13 other elections to look forward to over the next 14-15 months. I think the more relevant focus should be on the recovering economy. It does appear that the government's making a very determined effort to reflate the economy, to pump up economic growth. And I think over the next 14-15 months, that should be the key area of focus for investors rather than the numerous assembly election results that we'll deal with over the next year or so.
Saurabh, hi, morning. Do you think once this frenzy of the exit polls and then the eventual result outcome gets settled with, it's going to be back to tracking what global markets have been doing and what our own macro fundamentals are stating? I mean, just 3 days back, we were cribbing about as to how IIP has seen a downtake and how inflation worries are popping up again.
I think there'll be plenty to focus on, both on global and on domestic economics, honestly. I think once we get into January, we'll be looking at the first round of NCLT insolvencies. My hunch is even in January-February, in the January-February results season, there'll be plenty of difficult news from the banks about a further round of provisioning on the back of NCLT. As you're rightly saying, there's the global events. There's a new Fed chairman to look forward to, the biggest US tax cut in 10 years to look at. So I think I've very little doubt that 2018 is a year that'll be dominated by economics, not politics. I think it's probably one of those years which you'll remember for a long time, because you're seeing the end of QE, the beginning of normalization of the global economy, and potentially the pickup of the first major pickup in economic growth that we've had since the NDA came to power.
Saurabh, what do you make of the capital raising from HDFC Bank and HDFC Limited? I know you can't talk stocks, but HDFC Group are not stocks. These are institutions, right? The compliance says that you can't talk on stocks, but you can comment on institutions.
Nice try, Nikunj.
So look, I mean, my reckoning is a whole bunch of lenders will raise capital through this winter. We obviously know why the public sector banks will raise capital, but I think it's also clear that a whole bunch of private sector lenders will also raise capital. I think a couple of reasons. One, there's the obvious point that valuations are rich, investors are happy, willing to open their wallets and pump capital into Indian lenders. But I think the other point that banks are aware of, perhaps apprehensive of, is higher provisioning requirements once Ind AS kicks in. Ind AS kicks in at the moment on 1st April 2018, unless the RBI changes that. And the RBI has been pretty clear in saying in its financial stability report that it will lead to higher provisioning, lower Tier 1, and therefore I think lenders, banks especially, will gear up for that. So it's not just public sector banks. I think private sector banks and NBFCs will see a pretty active winter of capital raising, partly valuation driven and partly driven by the imminence of the new accounting rules.
Large part of the QIP activity or the IPO activity this year has been centered around BFSI space. That includes insurance, that includes the money which some of the NBFCs like Bajaj Finance and Mahindra Capital have raised. Do you think this is as good as it gets for the entire BFSI space, and from a return perspective for 2018 we should be in for very pedestrian returns, not the blowout returns we've seen in 2017 for the entire BFSI space?
I think cyclicals generally should do well in an economic reflation, and we seem to be heading into a reflationary economic climate. But I think the one exception I will say is wholesale market funded lenders. I think CASA funded lenders, banks who have good CASA franchises should be all right. Their cost of funding won't go up. But I think if you're a wholesale market funded lender, and all the NBFCs and housing finance companies by definition are wholesale market funded, some of the banks are wholesale market funded. If you're a wholesale market funded lender, I think your funding costs will go up quite materially over the next 12 months. Already we've seen the 10-year GSEC move up quite sharply over the last 3-4 months. At the short end of the curve, 3-month CP and CD rates are also starting to move up. And my reckoning is as the economy revives, liquidity will be sucked out of the financial markets back into the real economy. Liquidity will tighten in the CP and CD markets. The Fed will hike thrice, so Indian bond markets will also have to punch up their interest rates. So I think wholesale market funded lenders, I think potentially face a harder 12 months than CASA funded lenders. And generally in the cyclical space, I think that's the only area where I'm feeling a little apprehensive about both the valuations of wholesale market lenders and also the fact that cost of funding, the cost of the main raw material looks set to rise sharply after 4 years of relentless drop in cost of funding.
But in the event of PSP recapitalization, Saurabh, you do believe that that would have its set of beneficiaries as well, and that's going to aid, road builders, steel companies, for instance, right?
Absolutely. Absolutely. I think the PSU recap will have fairly far-reaching consequences. As you rightly said, road builders will find it much easier to get working capital lines. My reckoning was until 3-4 months ago, other than the top 2 or 3 road builders, for the rest of them, working capital was a challenge, even if they got the construction contract. I think that those problems ease off, and Bharatmala, as the government has said, Bharatmala tendering will accelerate through the year. Steel companies, there's plenty of stressed steel companies in the NCLT process. I think the larger incumbents will acquire these stressed steel companies at throwaway valuations, and the banks, the PSU banks, I think will readily finance them. I'm also hoping that some of the more beleaguered real estate developers who are currently borrowing at 16-17% from the private sectors, my reckoning is some of the more beleaguered real estate developers will also be able to get their loans refinanced by the PSU bank. So good reason to believe that cyclicals will get a real tonic on the back of the PSU recap.
HDIL 54.5. I want to mark HDFC Twins once again. HDFC Twins are not having a bad day, but it's not a very blowout day for the markets. It is not a very blowout day for any of the large themes. Saurabh, what to your mind will be the dominant theme of 2018? And when I say dominant theme, the dominant theme for 2018 has been liquidity or good macros. So what could be the dominant theme for 2018?
Our reckoning is that FY18 will be the first year in 5 that we see double-digit earnings growth. So our estimate for Sensex earnings growth for FY18 is 15%. We've not forecast double-digit earnings growth, believe it or not, for the last 5 years. So I think a genuine pickup in earnings, driven clearly by cyclicals, will, I think, become the central focus of the year. We've over the last 3-4 years, as you know, we've increasingly had to go down the market cap spectrum to find plays on consumption, and the Sensex really hasn't been the focus of attention for too many investors. I think a recovery in earnings driven by reflation in the economy, a recovery in earnings, I think, will bring large cap cyclicals back into the focus, back into the sort of center ground for investing in our country.
One is talking about when one looks back at year 2017, the IPO frenzy, how some of these new listings have made money. You talk about A, of course, the market valuations in itself, and B, now there are these new phenomena like Bitcoin and what kind of a bubble it has been, as big a myth as it may be, and none of us here at least understand, what the math behind why this frenzy. Do you sense that 2018 we could be getting into some sort of exuberance in the markets, or at least in select pockets one could see that start of the year itself?
I I think we've already got significant amount of exuberance in small caps. If you look below the BSE 500, I think there's a peculiar pattern. The weaker the company's fundamentals, the greater the stock price rally over the last 12 months. This is the small cap universe below the BSE 500. So just like Bitcoin gives speculators a sort of a venue for speculating in on a global stage, I think in our country, the sub BSE 500 small cap stocks, I think there's significant grounds to believe there's been a build up of speculative activity. But I agree with you. I think if you look at the overall picture, all the indications are 2018 will be a kind of a year of frenzy, with a global recovery, with our own economy recovering, with liquidity in the global market still being fairly plentiful. Although the banks have started tightening, central banks tightening, is still pretty early days. So plenty of liquidity and a synchronous global recovery. 2018 could well be the wildest year of this rally so far.
So let me pick up a quote from your favorite. Let me pick up your favorite quote. Let me rephrase it. And your favorite quote is a Buffett quote, a classic: buy fear and sell greed. So if I have to apply that quote in today's market context, I think there is a lot of greed and there is very little fear, and the fear is selectively in one or two pockets. So if you really have to apply your favorite classic quote, which is a Buffett quote, how would you use that quote and invest in this market?
I think the areas I would look at to sell and sell fairly proactively are these wholesale funded lenders. I think the valuations are extraordinary at the moment, and the fact that their funding base is fairly fragile, the funding base is the CP and the CD market. I don't think people fully recognize how fragile these entities are. So if one was to sell greed, I would sell wholesale lenders today. And to invert it on its head, I think if one was to buy fear, I would buy some of the IT and pharma stocks today. I think we've got, at the top of my head, at least two large cap IT names which I think are trading at very attractive valuations. They are strong cash generators, premier IT franchises, but trading at 15, 16 times earnings. And similarly in mid cap pharma, I can think of at least 2 to 3 names which are premier cash generating franchises, have been like that for 10, 20 years, and they're trading at mid-teens PE multiples. So I would buy two IT, 2 pharma stocks, four stocks which are mid-teens with strong cash generation track records, and I would sell pretty much all of my wholesale funded lenders.
Saurabh, I'm asking a couple of trick questions actually today. If I give you the option, let's say, to invest in only 2 themes or 3 themes for this year, what are those themes?
Two themes for the year ahead. I would look at aspirational consumption. I think we will see on the back of the GST rollback, I think we'll see a big surge in aspirational consumption, big ticket consumption, both in the auto end of the spectrum, but also in leisure and entertainment and clothing. So I would buy into aspirational consumption stocks. I know they're expensive, but I think there's at least half a dozen aspirational consumption plays that I could buy into, where in spite of the high PE multiples, I think there's very good visibility on returns. And the other theme I would play is cyclicals ex wholesale funded lenders. So I'll be brave here. I would say I would look at a couple of metals and mining stocks to capitalize on the global boom, capitalize on the synchronous global recovery. And I think Indian metals and mining stocks are probably the best bet amongst domestic stocks if you want to play the global recovery.
So far we've asked you questions on what will change. Let me ask you my final question on what will not change for 2018. You know, as investors, as market commentators, we always tend to focus on kya hone wala hai, kya change hone wala hai. Let's talk about something which to your mind will extend. It's where the earnings have been strong and earnings will remain strong, where market gains have been strong and market gains and market outperformance will remain strong.
I think I would say auto and the broader auto, electricals, building materials. I think that theme will remain strong through the year. As I was saying, I think aspirational consumption, there's good grounds to believe aspirational consumption will hold up through the year. Credit will remain cheap. People will be able to borrow cheaply from the banks. So aspirational consumption, auto stocks, electrical stocks, building material stocks, I think they'll continue trading at elevated multiples and continue delivering reasonably solid returns.
Saurabh, great speaking with you, and in case we don't meet again in 2017, here's wishing you a very happy new year from all of us.